Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show, and I am Paul Winkler. Talking money and investing and all that good stuff. And wow, can you believe it? We're there. It's like the show before election. Yeah, of course, I get lots of questions about, what do you think, Paul? What do you think? What do you think? And I had, I'm doing a whole workshop on post-election thoughts on Thursday. Yeah, I think it's Thursday. We're going to be doing that. It's going to be my reaction. And I have one client of mine. He's just like, yeah, I know what your reaction is going to be, Paul. I know it's going to be. And, no matter what, I know what it's going to be. The companies are going to figure out. They're going to figure it out. They're going to find a way. And, that don't worry about it. And I said, no, you have no idea what I'm going to talk about. I said, you don't know. Because here's the thing. Yes, I usually, when I talk about elections and I talk about who's in leadership, yeah, companies are going to figure out a way to get to profitability. It's like, for me, for you, for everybody, we're going to figure out a way to make it somehow, and maybe a little bit more challenging. It may be that you're having to figure out how to find an extra job if things aren't going well. You might have to figure out how to earn more money, or you might have to figure out how to reduce expenses, for work-wise. Let's say if you have an issue with work and things, maybe the economy goes against you, or the things that you do for a living, maybe that is squeezed, or there's something wrong there. You're going to have to find well, companies do the same thing that you do. Companies are going to, if all of a sudden taxes are raised on companies, and it's you just don't know exactly what's going to happen immediately. But if all of a sudden there are higher expenses, that there is a slowdown economically, or there are interest rate changes that are going against companies, or whatever, companies are going to do whatever they've got to do to try to increase sales if they can. If they have to move into different marketplaces, they will. But they'll reduce expenses. And I remember too well, doing this for over 35 years, I remember too well looking around at when the economy was going poorly, what companies were doing, and going, hey, isn't it interesting, the stock market's going up and the economy's lousy. And you go, well, how can that happen? How does that happen? Well, the way it happens is you just reduce expenses. And you lay off people like crazy. And then what happens is, of course, politically, that becomes very, very unpopular to whoever's in power. And all of a sudden, let's say the economy is not going so well, and people get mad and they vote the other direction. And sometimes it takes a little while for people to kind of figure that out. Or you have the other situation where things aren't as bad as what people think they're going to be. And stock market's a leading economic indicator. And the market will actually start to change or move a certain direction based on what they think is going to happen. But they typically they undershoot or overshoot what the expectations are. Is the example I like to give, and many of these examples are out there, but when Trump was actually in the very first time that he was elected, it was, the stock market went through this huge drop, the futures had dropped. And the concern was that things were going to be very, very bad. A lot of people just thought that they were going to be bad. And you have people and you look at it, you go, why is it so often that you have people on Wall Street split? And, even investment advisors, I saw a little study the other day of investment advisors are fairly split. Now, they're a little bit more in favor, the study showed, of Trump winning than Harris, but they were fairly split. And you go, well, why is it when you watch TV, you see people that are split that way as well, that are in the market, or they're in the investing world, or maybe they're CEOs of companies. And you can have certain companies that just love it when there is more regulation, because it creates a lot of it creates a barrier to entry, which can really mess up competition. If you're trying to compete and you're a small company and you're trying to move into a specific arena, But let's say the barrier to entry is very, very high because of the fact that there are a lot of regulations that you have to work your way around. Then you won't be able to enter into that arena because it costs you too much. Well, a company that's already in that arena is in the catbird seat because they have the ability to pay those expenses and work around it. Or they have ways to find loopholes because of their size and because of the legal staff that they have. So you can look at it that way. It's very, very hard to figure out what's going to happen with an election simply because there are too many moving parts. You could have a situation, and I think this is really important for American investors. You could have a situation where maybe the election goes a direction that isn't so helpful for U.S. companies, but it's super beneficial for international companies. I mean, that's something I was teaching in a workshop, and I was talking a little bit about last week, but it bears repeating. I was looking at all the different market segments, large U.S. stocks, and I have this vortex that I use, which is, like I said last week, it's like having a funnel sitting on its side, and you look at the left-hand side of it, and you'll have ranges of returns that are all over the place. And those ranges of returns that you can see for large U.S. stocks, you might have an expected return of 10%, but your return is never 10%, right? You don't have 10%, 10% unless you're Bernie Madoff. You don't get 10%, 10% return, 10% return, 10% return. No, you'll see it's up 32%, it's down 16%, it's up 25%, it's down 5%. It's up 40%, it's down 20%. It'll be in a range. But about 2/3, a little bit over 2/3 of those returns will typically be 10% plus or minus 20. So it'll be somewhere between 10 plus 20 or 30% return, 10 minus 20, negative 10% return. Well, that accounts for 2/3 of your returns historically. And it'll be, historically, it'll be between those two. Well, if I go, how about 95%, being confident in a 95% level? Now you take that 20, take it times 2. So 20 times 2, 40. It's 10 plus 40. 50% return. You could have a risk of a 50% return, or 10 minus 40, negative 30% return. Now, what happens is if we look at when we start to throw in other areas of the market, which is a problem that I see investors not doing. Matter of fact, I had some conversations this week. I was at a board meeting over at Trevecca. I was having conversations where, we deal with charitable giving and dealing with, setting up trusts and setting up charitable giving intent and investment portfolios, making sure that you're going to be taken care of throughout your retirement. And then what do you do after that? Do you have kids that you want to give money to? If not, who do you want to receive assets, and who do you want to help out? What do you want your legacy to be? That's a big topic of conversation. Well, one of the things that I see an awful lot of is an over concentration in big U.S. companies. And I've talked about it here. And I was thinking, we just got to get this message out there because enough people don't see it. But if you look at that range of returns, 10 plus 40, 50%, 10 minus 40, negative 30, that's a heck of a big range of returns. That's a big downside risk. And you can have literally go 10, 15, 20 years and have zero return in that area of the market. And I hear these stories, and you've probably heard this before too, unless you've never listened to any financial media at all. But Warren Buffett talks about putting money, his wife's money, in an S&P 500 fund. When he passes away, he wants it all to go to an S&P 500 fund. And people take that and go, well, if it's good enough for Warren Buffett, it's good enough for me. And I'm like, no, wait a minute. Recognize here is a guy that could put it all there. You could go, 3, 4, 5, 6, probably 18 centuries with no return, and his wife's going to be fine. She's not going to be living 18 centuries. She's got enough money. They spend very little. I mean, they live in the house that they lived in like the 1950s. He could do that just fine. You can't. It's not a good idea for you. He likes to make a statement about that, because And that's the statement is that, and it's true. If you look at investment advisors choosing amongst that universe of stocks, 500 companies, and their ability to get higher returns, choosing amongst that universe than what the S&P 500 has historically done, I mean, you got a better shot. You got a better shot winning the lottery almost. Well, it's not quite that bad, but it is really bad odds that you're going to get a higher return historically than the market does. And that's why you have guys like John Stossel, 2020, and then he was on Fox Business and he'd throw darts at the stock tables and he'd beat the professionals all the time. So the odds of you doing better than that are terrible, but that's not where the story is supposed to end. What you should be looking at is looking at other areas of the market, because during those periods of time, like if I use the 20-year period from the late 60s to the early 80s, so the mid 60s to mid to early 80s, where you had no return in the S&P 500, over that same period of time, you had British small companies, literally knocking the lights out return-wise. I mean, I think if I recall right, I think it was something like British small companies like 16, 17% per year return during that period of time. Japanese companies, I mean, you basically had the Nikkei, which is like the Dow. We have the Dow, and I'll talk about the Dow a little bit later. But you had the Nikkei go from 1,000, up to... It went up to, if I recall, it was like 50,000 or something like that. I mean, it was this huge meteoric, upturn in the Nikkei during that period of time. Now it came down some because after 1989, but over that same period of time, you had from 1966 to early 1980s, the Dow was at 1,000 and it landed at 1,000. I mean, it was basically at the same level. So large growth companies, literally not a whole heck of a lot going on. And then you'll have other market segments like when large U.S. stocks had no return between 2000 and 2012. You had small value companies, which nobody really paid any attention to. I'm just telling you, nobody was talking about small value in the late 90s. Nobody. Now, one of my professors he was saying, you got to make sure you're doing this. And he was talking about international companies and small companies and value companies. And, he was talking about it because he wasn't coming from a past performance is a good thing to look at. He did not. I mean, literally he's going, this is stupid. Don't look at patterns. Markets don't have memory is one of the things he would say. They don't look at what has just happened and have a memory and apply that as to what's going to happen going forward. That's just not how markets work. Different market segments. But yet that's what investors do. They tend to look back at these patterns, and it's called false patterning. They look at patterns that have happened in the past, and the recency bias is another type of patterning where you're looking at recently what happened and what's likely to happen going forward. But for investors, this is a problem, and I've seen it, and I've continued to see it, and I saw a lot of it this week, as a matter of fact. I saw a lot of it as I was getting into conversations with people. And one of the points that I was making is, don't get complacent, because if we have an administration change here, we're going to have an administration change, but, how different it's going to be can vary widely. You're going to see that different market segments may benefit significantly differently than others based on the new regime coming in. But the workshop, one of the things I'm going to be talking about is not necessarily markets. It's going to be tax policy. Because tax policy could be vastly different depending on who gets in. Because you're having estate taxes, that's going to be one issue that could be talked about a whole lot. I mean, right now you've got an exemption of 13,990,000, something like that. I think it is. So you have a lot of assets that can be passed from one generation to the next with no taxes, and you double that for a married couple because of what you have called portability. So you have the ability to bunch those two things together, and now all of a sudden you're looking at going down to 7 million. That's literally what happens after 2025. But you look at that and go, well, wait a minute. Is that going to change? Well, a lot of that depends on who is in office. Now, for some of you, you're sitting there going, I'm not worried about 7 million either, Paul. And that's fine. So that may not be an issue. But what about income taxes? Right now we have income taxes, 10, 12% tax bracket. Now we could see 12 go away and we go to 15. You got 22 and 24. Those two brackets could go away. And you got 25 is what replaces it. So a lot of people are going to be looking at higher income tax. Then you got on the other side, you got the possibility of, hey, I'm looking at possibility, reducing income taxes altogether. I don't think eliminating makes a whole lot of sense. I don't think that would happen. Typically what happens when somebody's a good negotiator, they will throw something out there that is really kind of crazy almost in hopes that they just get a little bit. It's like coming in and saying, hey, you know what? I'll buy that car off of you. And you're trying to sell it for $10,000 and they'll say, I'll pay you $6,000 for it. And you're like, no, you got to be kidding me. Okay, how about $8,000? Okay, deal. They shoot in the middle, right? Like that. Well, it's the same thing with taxes. You could say, hey, we're going to eliminate, but you might just reduce the taxes. There may be a significant reduction. Well, so much for the people that have been sold the idea of converting a lot of money into Roth IRAs, paying taxes right now at higher rates, only to avoid lower rates in the future. You could look at that and go, oh man, I can't believe I did that. And, that is a risk because a lot of times what happens, we do things for emotional reasons. We want to avoid taxes. Hey, nobody likes taxes. But is there a possibility, and I've been talking about this for a long time, that you have a consumption tax? We're talking about tariffs, and you look at that and go, tariffs. And some people say, well, that's, that could be a huge problem because we pay tariffs, right? We pay, that's an increase in the goods and the consumers pay it. But you're looking at it and going, well, if it's used strategically as a way of reducing imports from certain countries that they're not terribly happy with, or countries that are setting tariffs on us in return. So there's just a lot of stuff that's just being done for negotiating purposes, and it's really hard. I mean, we look through the glass dimly. It is really, really hard to figure out what's going to happen. But I think, it's going to be interesting as we get into next week. We see, does anything pan out? Does anything change? What's going to happen? Who wins? And how divided? Is there a division? With Congress first, the Senate versus the House versus, the presidency. And then with division, sometimes markets love division because then you can't get things through that quickly and you got to think about them a little bit more. So I think that's going to be interesting. I'll be talking a lot more about that on Thursday. That'll be a workshop that you go to my website, paulwinkler.com. And that you can actually sign up for that workshop. I'll be talking about that. Now, I'm going to talk about something I did see. There are a couple things that I did see this week. And, just because I look, people say, hey, Paul, can you look at this portfolio? So I got a chance to look at a lot of portfolios that I don't normally get a chance to look at as much. And I'm seeing some things that I want to teach you to look for, as signs that there might be a problem or that somebody has recommended that you do something that could be really bad for your wealth. You talk about doing things that are bad for your health. I want to be talking about things that could be bad for your wealth because I see a lot of stuff. And I'm going to talk a little bit about some of the things I've seen in the past. And I'm going to tell you about the things that I see now and how to ferret that stuff out. All right, back on the Investor Coaching Show, I am Paul Winkler. Yes, so paulwinkler.com is the website. So yeah, if you want to jump on there and just sign up for that, you want to get on there for my post-election workshop. I'm going to be out there Tuesday with all the folks from the station out there, Wilson County, I guess it is. So that'll be a lot of fun. I'm really looking forward to hanging out with everybody. Somebody was, I had a lot of people that were having me take a look at investment portfolios and just asking me about stuff, at something I was at this week. And one of the things I see a lot of, and let me just speak to this because it was something that I don't talk about a lot because I just thought for sure people aren't doing this. Investment advisors aren't doing this, and I was shocked how often I saw it. But it's where when somebody will pull up a portfolio and say, hey, Paul, look, here are all my holdings. And I will go through them. And if I see a lot of 4 and 5 star funds, I'm like, whoa, wait a minute. There's a problem here. And, as a matter of fact, there was a guy that was an ex-financial advisor, and he and I were taking a look at something, and he pointed out some stocks, and he was pointing at the star ratings. And I said, don't pay attention to that. Do not pay any attention to that. And he goes, oh. And I says, yeah. I says, the Wall Street Journal actually had an article mocking that, and they called it the 4 to 5 star curse. Literally called the 4 to 5 star curse. It is not like staying at a hotel. If you go to a hotel and it's a 5-star hotel, you're probably going to get decent service. It's probably going to be a pretty good experience. Even a 4-star hotel is going to be a pretty good experience. If you go and buy 4 and 5-star funds, you're probably looking at, not definitely, but you are probably looking at, it's going to be a bad experience. And we know this from the research. And the reason being is that markets go up, they go down, and what follows up, down. If you have a good past performance does not tend to continue. It doesn't tend to carry on. And if I see somebody with an investment portfolio of 4 to 5 star funds, 4 to 5 star ETFs, I'm usually going, there could be a problem here. And you go, well, why? Well, because it is quite probable that if you're not managing your portfolio, that there's an investment advisor managing this portfolio, they just added those funds. Because if it's not persistent, if you don't find that the good performance is persistent, that it continues on, then chances are super good that that fund was added after the performance was good. And then what happens is you own it. And then it underperforms while you own it. And then they go, hey, we got to get rid of this. And they get rid of it. And then they buy the next performer that did well during the most recent period. But here's the problem. You own it when it's doing badly. You don't own it when it's doing well. That is so often what happens. Remember, there was somebody brought in a book, and it is super, super nice. I mean, hardbound book, really nicely done portfolio analysis. And they brought it in and says, here's my stuff. And what I did is I followed it. I took the funds that they recommend that the person buy. I just held on to the book for a little while, the recommendations that they were making. Now, in the book, what they did was this. And this is how it's often done. They will say, hey, look, the stuff you own right now, if you had owned what we're recommending, here's how much better your performance would have been. So what they do is they appeal to your sense of greed and your fear of missing out because you weren't doing what we recommended. You didn't have those things, so you didn't get that better performance. You need to go with us and put your money there. So what happened is they had this whole list of recommendations, and they said, here's what you need to do. Well, I dug into it. The fund, the investment manager, the investment advisor company in question did not themselves hold the funds that they were recommending during the period of time that they were showing, which is a little bit disingenuous. They're telling you, hey, if you had owned the funds we're recommending, you would have done this much better. Well, they didn't even own them during that period of time. And they didn't tell you what they did own during that period of time, by the way. So that's pretty bad. But furthermore, what they did is they had this list of funds, and I just followed them for the next few years. I wanted to see how they did versus their benchmarks. Now, different areas of the market have different returns. Like small companies, you might have for a 10-year period that small companies don't do that much. They don't do that well. And then all of a sudden they do super, super well. You just don't know how they're going to do or when the performance is going to come in. But you'll have single years where a small company stock fund might go up 70%. I mean, bam, just like that. And if you're not there, and a lot of that performance occurs in a very, very short period of time. If you're not there, you're out of luck. And if you bail out before that happens, you're out of luck. So one of the funds that they recommend that the person buy was a small cap financial fund. And you recommend, and you benchmark that. I benchmarked it against the DJ financial asset category because that was its benchmark. That's what Morningstar benchmarked it against. Well, over the next 3 years, the fund underperformed its benchmark by 8%, then 7.6% the next year, and then by 9.84% the year after that. Well, so much, I mean, like 30%, almost 30% out underperformance. I mean, brutally, brutally bad. And then they had another fund that underperformed where, if you had put money in this thing, your fund, your money would have grown. Your $10,000 would have grown to about $14,000. Better than poking the eye with a sharp stick. But it should have grown, according to Morningstar, to $18,000. So that's about a $4,000 underperformance on a $10,000 investment. Then the next fund, I mean, it's just literally almost 3% per year underperformance. 3% per year for the next 10 years, the next fund that they had recommended. So much for its outperformance before. Then when they recommended it, it was like bad luck for the fund. Once they recommended it, it was like the curse on the fund. They recommended it and then it underperforms. The next fund that they recommended was a small value fund. And then it went on to underperform not only when I did the analysis here today, but it had a 1 month underperformance, 1 year underperformance, 3 year underperformance, 5 year underperformance, 10 year underperformance. I mean, basically in every time period you could think of, it underperformed. Then the next one, same thing again on a small value fund, another small cap equity fund that it went on to underperform, 12% and 4% and 1%. So literally it's really bad luck. No, is it bad? No. This is what they found in research on pension funds as well. Pensions engaged in this same type of activity where pensions, you think, hey, these people are well educated. They do a lot of analysis and they should look at their funds and they want to make sure that when they look at a fund in their pension, they want to make sure that they have the best fund for their people that are in their pension plan, for their employees. Well, what they found in the pension was the funds that had underperformed, they said, hey, these funds didn't do so well. We need to get rid of them. Hey, what's a fund that has a little bit better performance in that area of the market? Oh, the ABC fund had a better performance. Let's get rid of the XYZ fund because it's pretty bad. And let's put the ABC fund in its place because it's done better over the past 10 years. Then what they did, this study of pension was brilliant because the graph was really good. They had the ABC fund way outperforming the XYZ fund that was way under. Then they had the line of demarcation was when they made the change in the study. They got rid of the XYZ fund because it had underperformed. They bought the ABC fund. And what happened? It was almost comical how they had changed places. The XYZ fund that had such bad performance in the previous period of time went on to outperform. The ABC fund that had done so well went on to underperform. Now, the problem was the people that were in the pension plan got the bad performance of XYZ when it had done poorly, and they got the bad performance of ABC when it had done poorly. So they're the ones that took it on the chin. But they felt good about themselves. Hey, we're getting rid of the loser. We're putting in the winner in its place. That's the problem with this method of managing money. So look at your statements. Here's the thing, real quick before we go to a break. Look at your statements right now. Look at the fund names. Maybe take a list, or if you got a really good memory, you don't need to do this. But write down a list of the funds that you own and look at the list of funds that you owned 5 years ago. If you're seeing changes Now, there may be minor changes because maybe that one fund is, there was a fund that was replaced. Like if I replace a fund, it's because there's a lower cost version of it. But that's, rare because, try to keep the expenses as low as you possibly can. So you don't have a lot of changes. You shouldn't do that. You shouldn't have lots of changes. But if you're seeing like changes in funds like this, and you're getting trading reports all the time, it's a good sign that they may be getting rid of the losers that you were in when they were losers and putting you in tomorrow's losers. And this is what you look out for. I look at when I see 4 and 5 star funds and that's all I see in a portfolio. That's one of the things that tips me off to do the second step, which is look at a statement from 3 to 4 years ago. Because I'm telling you, 4 to 5 star curse is what Morningstar basically said. And I have seen it over and over again in my career. These funds do not tend to persist. That's what we know from the research.